Watching Bitcoin to gold, Bitcoin is moving up relative to gold. This would suggest that we've held the sort of the higher lows. The trend is up, shall I say. The trend is up over time. And we do believe it is up over time. We would not be surprised to see gold continue to fall, especially if we're right on the dollar, and Bitcoin continue to increase. And here, two measures of measures of risk, credit default swaps in the banking system, especially with the private credit debacle we've been saying. We've said it's not systemic.
If you found this helpful, please like, subscribe, and turn on notifications for more insights into the digital asset space. Your support boosts the algorithm and helps this channel grow immensely. Drop your thoughts in the comments below. Thanks for watching and enjoy the rest of the video. For Ark Invest, the Bitcoin to gold ratio is a critical indicator of risk appetite and the future of money. Wood highlights that Bitcoin is consistently making higher lows relative to gold. She predicts a scenario where gold continues to fall, particularly if the US dollar remains strong, while Bitcoin continues its upward trajectory. This isn't just speculation, it's a reflection of Bitcoin being viewed as a flight to safety asset that also captures the growth of a new digital monetary system. Wood also addressed the private credit debacle. While some analysts fear a systemic collapse in non-bank lending, Wood points to credit default swaps and high-yield spreads, which remain remarkably low. Her verdict? The sell now, ask questions later mentality in the fintech and software space has created a babies out of the bathwater opportunity for savvy investors.
The trade deficit, which is the last piece of GDP that we review, we doubt is going to improve much from here because imports are increasing faster than exports. And doesn't surprise us. We think our relative growth rate is higher than the rest of the world. So I've said this before, we don't worry about this deficit that much. Because the flip side of it is a capital surplus. Again, foreign direct investment coming into the United States, equity investment, and so forth. Here we're into market indicators, and we're beginning to see slow, but that metals to gold ratio in green there, it's trying to turn. Maybe more because gold is falling than metals increasing, but at least we're seeing some stabilization. We are not seeing much of improvement in the 10-year Treasury yield. But if growth picks up dramatically and the 10-year Treasury yield were to stay around here, that would suggest that the yield curve is going to continue flatten and perhaps invert and in a recovery. And if we look back to the last technology revolution, which was telephone, electricity, internal combustion engine, building on the railroad ecosystem that had been built out in the United States. During that period, the 50 years through the roaring 20s, the yield curve was inverted most of the time, and the average inversion was roughly 100 basis points. Here is the price to gold ratio. As I've mentioned, a strategist I've always admired, Charles Gove of GovCal, it really believes that we're going back into a 70s style environment. And here you can see the S&P fell relative to gold very dramatically. He is focused on our deficit, the government deficit, and our debt level. And I've already told you what we think about that. We disagree with him. We think this is going to reverse, and we think it will go to all-time highs. We've got a little bit of a leading indicator here. Despite the rapid increase in oil prices, this ratio, S&P to oil, is closer to its all-time high. And we like to look at both gold and crude oil, often do a ratio of them. But here with transitive property, you can see we're using the S&P. and it's closer to its high. So we think it also will go to an all-time high, because we really do think oil prices, now that the UAE has moved out of OPEC, that it's going to open the floodgates. It's been frustrated for years and years. And of course, we have Venezuelan oil gushing out as well. And the US, it is stunning. The US crude oil exports have gone from essentially zero in 2015 to 6 million barrels per day. And our production is at 13 million barrels per day. And this oil price is inviting, it's a clarion call for even more production. So we think we're going to see big drops in oil prices in the years ahead. And of course, Russia it's the only way to finance the war, but it'll be the only way to finance its return from war and getting its economy back on track. And finally, in terms of, at least we have a few more indicators, but these are the big four for us. Watching Bitcoin to gold. Bitcoin is moving up relative to gold. This would suggest that we've held the sort of the higher lows. The trend is up, shall I say. The trend is up over time. And we do believe it is up over time. We would not be surprised to see gold continue to fall, especially if we're right on the dollar, and Bitcoin continue to increase. And here, two measures of risk, credit default swaps in the banking system, especially with the private credit debacle we've been saying. We've said it's not systemic. This would corroborate it. The latest tick here has been down. And finally, the high yield spread, high yield bonds or junk bonds relative to 10-year bonds in terms of their yields. Again, very low by historical standards. No spike in the aftermath of the private credit sell-off here. So with that, that's good news. I know that the market has been trying for this year, even though the market itself is up. The innovation space has been frustrating. Parts of it have done very well. Anything in space and defense tech has done very well. But anything touching software, even fintech and the payments ecosystems, they have been hurt. And we think there's a lot of confusion. Sell now and ask questions later. So as you can see, because we post our trades every day, we've been picking some of the babies out of the bathwater as it's been thrown away. So we're expecting, though, as the economy turns around dramatically, as July 4th gets closer. It is our 250-year-old birthday party as a country, and we think there's going to be a lot of optimism around that period. We hope that the administration gets what it wants in terms of the Clarity Act being passed by July 4th. That would be a boon for the crypto asset ecosystem. And we also, of course, hope and pray that the Iran war, and whatever it is right now, that it is done and that oil prices are resolving on the downside of expectations, inflation as well, which should drive consumer sentiment higher. We certainly think that the administration is trying to foster this scenario because of the midterm elections. Time is short and takes a long time for perceptions to change, but same thing here. Commodity prices. Here's another way that you can see that, and this is not just oil, this is lots of commodity prices are starting to move up because we are in the middle of, we believe, or in the early stages, better said, of what we believe will turn out to be a manufacturing boom. So demand is increasing relative to supply, and we'll show you some green shoots later on. And yet, here again, the yield curve, as I just mentioned, is flattening. So interesting. Here you can see inflation itself as measured by the core CPI and the core PPI. And what you're seeing, interestingly, and it doesn't happen very often, is the producer price inflation in green on a year-over-year basis is above the consumer price inflation, which is in the purple. Now, when does this normally happen? Normally happens during recessions when the consumer says, I can't pay. I'm not going to pay anymore. And as I said, we think this is a vestige of the rolling recession that we believe we're exiting now. But it does seem to corroborate that we have been in a painful environment and that consumers just are not willing to pay. So the consumer goods companies certainly and services companies are having to eat some of these input cost increases. So, and then here you can see, this is a measure, we haven't really shown it here before, but it's very commonly used by the Fed. It's one of the metrics they monitor. And I think Kevin Warsh even more so. This is looking forward 5 years. What is the expectation for the 5-year annualized rate of inflation going forward? And as you can see, despite all the headlines about inflation, it's below the average of the history of this chart, which goes back to 2000. And it has essentially been stuck in a range for the last 3 years. The latest tick up is related to oil prices, to be sure. But we think this is going to reverse. And I'll get into why we think so in a minute. But here's another Kalshi question. Will core CPI inflation fall below 2.2% this year? And you can see that the odds here are very low, according to the wisdom of crowds. Now, we would disagree with this one. You can see where it is right now. It's at 2.6. It has been coming down. It has been coming down 2.6%. And this takes out food and energy. So energy, the direct increase in energy prices is not in here. The indirect impact of energy costs is in here to some extent. But as I just mentioned, consumers are saying, we're not paying that. And so 2.6% is where we are. And again, in the context of history, and this goes back to the 70s. 70s were very inflationary. 80s, 90s, disinflationary. Post global financial crisis, you can see steady state around 2%. And we're closing in on that. But most people in this survey do not believe we'll get below 2%. And I think this is in 26. Yes, in 26.
The most visible sign of the new economy is what Wood calls a manufacturing boom. We are seeing a massive breakout in capital spending, CapEx, that has shattered a 35-year resistance level. What's driving this? Deregulation and tax policy, favorable conditions for US-based businesses, the AI and power boom. Data centers and AI infrastructure require physical hardware. The CHIPS Act. Despite a temporary dip from the $120 billion peak in semiconductor manufacturing construction, Wood believes this is a structural shift toward domesticating the supply chain. Most interestingly, she notes that the old guard of tech companies like Intel, Cisco, Corning, and Akamai are being pulled back into the spotlight. Akamai, for instance, recently received a massive hyperscaler order to leverage its content delivery network for AI. The message is clear. The AI revolution isn't just for startups. It's an all-hands-on-deck moment for the entire tech ecosystem.
Here you can see that existing home sales, nope, relapse. The spring selling season was terrible. We're in recession territory still. Here you can see the inventory of new one-family homes for sale, and it's starting to come down. Builders are starting to clear, probably with lower prices, and we may see that intensify if during the next few months in response to the recent tick up back up in mortgage prices. They're going to cut prices to clear their inventory. You can see this is an interesting new chart. U.S. home buyers, the number of U.S. home buyers, which is in the purple, those are down to 1.4 million people. And the number of sellers are 2. And you can see that we've never, at least in the history of this chart, it's a short history back to 2014, we've never seen this big of an imbalance between buyers and sellers. So here's a question for Kalshi around that. Mortgage rate, will it average below 5.75 this year? And you can see there's a 19% chance. That is probably right. And the reason for that is, well, first let's show you where it is. We're at 6.4%. We've seen a little bit of a backup. It had ticked right below 6. And so that 5 handle was getting people excited. But if we're right and the economy is really on the good side, is starting to take off and services follow, interest rates may not come back down that much more. So stay tuned. The clearing of the housing market may have to take place more through pricing than through interest rates. Now, here's the good news. Capital spending is beginning to boom. Now, what's interesting about this chart, and I've watched it really since the early 90s, we peaked at roughly the same level every other cycle. And now we've blown out and are moving rapidly away from that former peak. So, in the stock market, when you say you've had a big base and it's lasted, in this case, 30, 35 years, the breakout is significant and probably will be sustained, I think, thanks to the deregulation and favorable tax policies here in the United States, as I discussed earlier. Of course, the AI boom and the power boom is behind this, but we're even beginning to see capital spending away from those two spaces moving higher. And in fact, what's been so fascinating is Intel, Corning, Flextronics, now called Flex, names from the previous bubble, Cisco, today Akamai, my goodness, it's been, a single digit grower for forever. And it's now gotten a hyperscaler order, wanting to leverage off its content delivery network. These are blasts from the past, and it's basically saying that this AI boom is carrying, the old guard along with it. All hands on deck. Let's do this. So it's fascinating. But look at this. This surprised me. This is manufacturing construction for computer and electronics. And it's into this year. And I said, what the heck? This includes semiconductor manufacturing and other component manufacturing in the United States. It's going down. What's that? It's the CHIPS Act in 2022, which was part of the stimulus that year, as trying to get us out of the COVID crash. And you can see how extended it was. We went from below $20 billion to $120 billion. So that's a six-fold increase. And now we're down to 70. We think this is going to turn around for obvious reasons. And it will add to that non-defense capital spending.
Wood isn't blind to the headwinds. She admits the housing market is in a relapse. We are seeing a historic imbalance between buyers and sellers, with mortgage rates hovering in the 6% range. Because she expects the economy to take off, Wood warns that interest rates may not come back down as much as people hope. This means the housing market will have to clear through price corrections rather than lower mortgage rates. For those waiting for 3% interest rates to return, Wood's data suggests you might be waiting a long time. The market will likely force prices lower to meet the reality of the current rate environment.